Hey, how's it going? I'm Seb, and today I wanted to get into value investing and what it means to actually see value in something. I'm gonna be reading it out of the Intelligent Investor because this really makes you smart, especially even if you have no idea about investments. It's a good book just on strategy, actually. And I wanted to kind of read different things out so that you don't have to read this book. Instead, I will give you very meaningful things from it. And this first part comes from page 35. This one, it really means a lot, especially to me when you really think about what actually goes into stocks. So it starts, why do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the market did that day? Because whenever you trade, they make money whether you did or not. And that's just true. The same thing with taxes. They'll take your money. Doesn't matter. But because whenever you trade, they make money whether you did or not. By speculating instead of investing, you lower your odds of building wealth and raise someone else's. And this really goes into expected value and what you think you're gonna get out of something. And the lower the risk, the higher expected value because of many different factors. But when you actually go in and investing, you want to invest in the long term because your expected value increases. It steadily increases because you're not really there to trade every day and increase that risk. And it's another part was that Graham's definition of investing could not be clear. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. And I mean, you couldn't put it better, but if you're a trader, you don't really see that anyways. And I think just the value investing is that point is the principal and an adequate return as well. And there are three elements that really go into it. You must thoroughly analyze a company and the soundness of its underlying business before you buy its stock. So that really goes into narrative trading and really what it it is like emotions or maybe some news article earlier that day, oh I should buy this, buy that. No, it's you should do your research actually because a lot of narrative traders they don't really make too much money. Yeah, they have a high upside. They can make a ridiculous amount of money, but their odds of actually making that are so low that your expected value is almost nothing. And that's just the truth for a lot of speculation. And those who actually hit it and make it big, they really do make it big, but sometimes it really just comes down to luck and really did you did you really hit that ratio or you were in right place, right time. Sometimes that is the case. The second element, you must deliberately protect yourself against serious losses. And this is a great one because everybody makes 10% in the market and everybody loses 10% in the market. But what makes a really good investor is not that they make more than 10%. That's good. But if you can't protect your downside, it doesn't really mean anything on those gains because you just lost them all. So really, what you want to be a very good investor is to have amazing downside protection. So you go up 10% when the market goes up 10%. When the market goes down 10%, you only go down 5%. And you, right then and there, you beat everybody out of the water. And when it comes to long-term investing and investing in something with value, this is actually something that is really good. And one way to do that is by diversifying. And that really goes into a big picture of what you're trying to invest for, but diversification might mean different sectors or in a specific sector you want maybe different companies, but the greatest example is the S&P 500. I mean that thing makes you money just by throwing it in there. Just over time you make 10 to 12%. It's amazing. And the third element, you must aspire to adequate, not extraordinary performance. And this is because with the higher risk, the higher price, but not only that, but usually with an adequate return, you don't have to stress about it. You don't have to check your portfolio the next day. You don't have to do anything when it comes to emotions, and that is really the best part and a really good lesson that comes from The Intelligent Investor. And it doesn't get better than that. Is the You learn so much in this book, and I'm gonna share more about it in other videos too. And thanks for watching, because this is some powerful information.